you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and here with me today is Kerry Craig, Global Market Strategist for JP Morgan. Hello Kerry.
Hello.
So we're here today to talk about Europe. There's some rumours this morning there may be a QE package. Do you have the details?
Yes, we've had a minister from the ECB come out and talk about the fact that perhaps sovereign bond buying might come a little bit earlier than perhaps Mario Draghi is letting on. There's a definite movement and shift towards the ECB doing more next year in terms of what it can do and increasing the money supply. I think they have a very credible pipeline in place at the moment. They want to see that pipeline push through into the economy before they do more bond buying in terms of government bonds or even non-financial corporate bonds. The big picture thing will be the December TLTRO, what the take-up is of that by banks. The one they did last month was a little bit weak. They're a little bit worried about the pickup. If we see a strong number there, I think that'll alleviate some of the concerns about sovereign QE or maybe push back the expectations for when that will happen next year. But to get to that all-important 3 trillion figure on the balance sheet that the ECB wants and to increase it by 1 trillion, I think more bond buying of some form is going to happen next year.
And how will that work? Because we kind of understand how QE works in a one-country single market, but that's not what the Eurozone is.
No, this is the added complexity. You have the Eurozone, it's 18 countries, it's 18 different central banks who are all feeding into the ECB and sharing their views. And that was a very important point last month. And when Mr. Draghi had his November press conference, he really took that opportunity to tell the markets that he had his house in order and this was a consensus view that he was putting forward. The ramifications of whether sovereign bond buying would actually work and actually go towards helping the Eurozone is still up for debate. In the UK and in the US, you had bond buying of government bonds, which actually worked to lower corporate bond yields and feed through into a better housing market and improving the cost of borrowing for many companies. However, in the Eurozone, companies don't always tap the bond market for their financing. They want to get it through banks. So bank lending is probably a more crucial aspect than just lowering yields. And it also raises the question about the moral hazard that Germany always points towards for some of the periphery countries or crisis economies, and whether that actually alleviates them or removes some of the pressure for them to push through the very necessary economic reforms that are needed to get good economic growth in the Eurozone.
The thing is, we don't actually need this sovereign bond buying to work. We just need to think it's going to work. Isn't that right? Sentiment is everything in the Eurozone.
I think, yes. So markets often react, especially equity markets, will react to the promise of something coming, not the fact that it actually happens. And that's what you're seeing in the Eurozone at the moment. The stock 600, for example, is only less than 1% away from its peak. It was in early October before we saw the sell-off. A lot of that has returned to the Eurozone as people have looked towards next year and people are thinking, well, maybe there's a few factors that I think are going to explain a better economic climate than perhaps we've had this year. Not a great one by any means, but perhaps more stability, a weakening euro, the Eurozone central bank which stands ready to act, the fact you have less austerity as well, and the fact that some of these reforms at the country level are coming through at a very slow pace but are starting to materialise. In the case of Italy, the Jobs Act that got passed this morning is a perfect example, and how that can lead to better economic growth in the future.
So 2015 looking better for Europe than 2014?
I think it's looking slightly better. I think there's reasons to believe that markets are being a bit too pessimistic towards what could happen, that it probably won't just be as bad. It's not going to be stellar growth. You know, we're still looking for sort of less than 1% for next year, but maybe there's enough to say we'll avoid an outright recession, we'll avoid outright deflation. Those are still very big risks that are with us, but given where markets are in Europe compared to, say, the US, there's a lot more upside potential there.
Kerry, thank you very much.
Thanks.
This is Emma Wall for Morningstar. Thank you for watching.